Are you an investor looking for premium market opportunities? Presenting premium and exclusive service for investors by Kalkine.
Buying a residential property in advanced economies like Australia can be a very costly affair. In 2021, house prices soared by more than 23%, registering their steepest annual growth ever. An increase in the price also means higher mortgage loan repayments for buyers that avail a lending facility to fulfil the dream of not living in rented accommodation. A mortgage loan can be both simple and complex. Simple because it's no different than any other borrowing where the principal must be repaid along with the agreed upon interest. Once the repayment is made, the line of the creditor over the property terminates. However, complexity seeps in when multiple lenders compete to sign up eligible borrowers for their services. Even though this works for the advantage of the borrowers, one might find it difficult to pick the best offer. So with that in mind, let's break down 3 basic points that a mortgage seeker needs to consider. Firstly, the lender. The Australian mortgage market is a multi-trillion-dollar space, and this has lured in an ever-growing number of participants. Big banks in the country, often referred to as the Big Four, have mortgage as one of their primary sources of revenue. However, there are a host of other lending options, which in turn has increased competition, and this can be favourable for consumers. Mortgage products by new financial technology or fintech participants can be looked at in case these provide tangible benefits to the borrower. At the same time, how a lender's lending terms and costs compare with that of others should be looked at closely before making a final call. The rate. The interest rate is the thing that makes the biggest difference to any loan. The significance becomes even more in a mortgage loan because of the long tenure. There are 2 points to consider here. 1. What is the generally prevailing interest rate on mortgages? And 2. What is the rate offered by a specific lender at that particular time? The average interest rate for a new mortgage loan in August 2022, with respect to an owner-occupier borrower, and including both principal and interest, was nearly 3.9%. This can change according to the benchmark rate set by the Reserve Bank of Australia. It's important to know what the exact interest rate charged by a specific lender is, because even a small difference can cost thousands of dollars in total repayments. And thirdly, your capacity. Avoiding burdensome debt is obviously always a wise decision. Here, a mortgage seeker must always first look at whether the desired loan amount is sustainable. Financial health is paramount, and a mortgage loan is a very long-term commitment. You would never want to buy a house that could be a burden later on. For this, it's advisable to exercise due diligence, especially when the housing sector is so hot. Getting a mortgage loan approved and repaying it over many years are 2 different aspects. There can be a few lenders that might be interested to extend a loan facility even to borrowers with weak financial health. But this can come at the cost of a higher interest rate that can only add to problems instead of benefits. The bottom line is that you need to know the lender and the terms they are offering inside and out. You should only pick one after weighing all the available options, comparing the interest rates charged, and never overreach your own financial position. So there you have it. Hopefully that gives you a good baseline knowledge of entering into a mortgage. Let us know your thoughts in the comments below, and don't forget to like and share the video. For more content, you can subscribe to the channel and press the bell icon. I'm James Preston, reporting for Kalkine Media.